Good morning. Good morning. Well, we are here on the program, Dollars and Cents. This is Joel Garris of Nelson Financial Planning. On the show today, we're going to talk a little bit about some tax issues in divorce. We talked previously a couple weeks ago about the battle of the sexes and asked the question of whether that's raging at your house. Well, what if at the end of the day that battle is fought and unfortunately nobody wins, everybody loses? What then? So we thought we would talk a little bit about divorce and how that relates to your finances. Plus, those of you who are collecting Social Security, we know the pay increase that's scheduled for 2020. Hard to believe that it's 2020 next year, right? They've already announced the pay increase that you're going to get, and so we'll talk a little bit about that on the program. Plus, of course, we will take your calls, 407-916-5400, toll free, 1-866-916-5400. Those are the ways in which you can get in touch with us during the course of the program here. And, of course, you can also send us an email. That email is my first name, Joel, Joel, at nelsonfinancialplanning.com. Those are the ways that you can add your topic to our list of conversations today on the program. This is, of course, Dollars and Cents. We're Central Florida's longest running radio program. Started 30-odd years ago. The tradition continues today by me, yours truly, Joel Garris of Nelson Financial Planning. So, busy week, as always, in the markets this past week. The major dominating headline was, of course, the trade conversation, the trade deal. The markets obviously responded positively to the news that there was some kind of a deal in the works. I'm not sure the depth of that deal. It sounds like really more of a detente rather than a deal. But be that as it may, at least the two sides are, I guess, getting along somewhat. And so the market actually was positive for the week. Up, the Dow was up 240 points. And so that was the major sort of dominating headline this past week. Looking ahead to next week, we have the real start of earnings season that'll kick off with a lot of companies announcing how things were for the third quarter. The reality is that sort of starts on Tuesday. Why does it start on Tuesday rather than Monday? Well, tomorrow is actually Columbus Day, and Columbus Day is treated as a federal holiday. So what that means is that there's no mail and there is no bank services or those kinds of things. And so a lot of those earnings announcements will get started on Tuesday rather than on Monday, with it being a federal holiday. So those are the things to be thinking about in the week ahead. If you're trying to think you're going to get your mail tomorrow or go to the bank, probably not. It's not going to be open. So Columbus Day tomorrow makes it the earnings for corporate America really will not start until Tuesday. So those are sort of the important things to be aware of in the week ahead. And then similarly, one of the big announcements last week was that every year around this time, they announce how much your Social Security is going to go up. And so they announced it. Don't get overly excited about it, because as you might well imagine, with interest rates and inflation being as low as they are, it wasn't a ton, but at least as opposed to some years in the past where we've seen no increase, at least there was a small increase. That increase wound up being 1.6%. So on $1,000, that equates to $16. So not a whole lot, but at the end of the day, still a little bit of a bump up in that Social Security and the amount that you're going to get based upon the cost of living. Now, The other thing that they announced simultaneously with the inflation increase in your Social Security benefits is also the maximum earnings that you have to pay Social Security on. Now, remember, Social Security and the taxes that are collected on Social Security, which is 6.2% of your earnings, not investment income, not rental income, not dividends, not capital gains, but it's earned income is where that 6.2% tax gets collected. And there's a cap, though, on how much of your earnings are subject to that 6.2%. And every year that cap goes up. So for next year, the year 2020, the cap for Social Security wage increases to $137,700. That cap is one of those things where the folks in Washington sort of talk a little bit about that cap from time to time when they're looking for ways to help improve the finances of Social Security. Because by capping the amount of earnings that are subject to Social Security tax, then obviously you're not taxing all of the earnings out there in America as a whole. And so one of the solutions in terms of trying, or suggestions and solutions to try and improve the overall finances of Social Security, is to raise the amount of earnings, or effectively eliminate the cap, so that if you have earned income, then you must pay into Social Security, and there isn't some threshold of once you get past it, then you don't have to do that. So that's one of the things that I think in the years ahead, as hopefully the folks in Washington decide to get their act together and maybe focus a little bit on the financial condition of Social Security, that's one of the items that I think we'll see a lot more about, or hear more about, because by having that cap, then you've got a lot of earnings that don't actually have a pay-in to the Social Security. So they keep increasing it every year. I think in the future we'll see that they really are going to eliminate that cap. But be that as it may, cap still exists, and it increased up to $137,700 for next year, along with that 1.6% increase in your retirement benefits that you get under Social Security. Now, one of the things that has changed under Social Security is this notion of collecting spousal benefits. And that actually changed. It's funny how time flies. That actually changed back in 2015, but a lot of folks are still sort of under that impression of, well, can I collect on my spouse's benefit and let my benefit continue to appreciate, continue to run up, and then switch to mine later on? And that strategy basically took advantage of the fact that a spouse can collect under their spouse's benefit and let their own benefit based upon their work history continue to graduate up until it maximized out at the age of 70. So that was certainly one way in which to take advantage, if you will, or maximize out your Social Security. And many folks would do that and collect on their spouse's record and then wait. And then as they were waiting, their own Social Security check was continuing to go up, because, of course, if you don't collect your Social Security, then it actually continues to go up. Then it sort of caps out at age 70, where there's no more increases available. So many people were sort of applying. And obviously, the numbers had to work on that. I mean, if your Social Security benefit was so much greater than your spousal benefit, which generally is half of what your spouse was getting, and then obviously you wouldn't really do that strategy. But there were many that were, maybe their Social Security benefit was sort of close to what their spouse was getting, and or close to half of what their spouse was getting. They would apply as a spousal benefit, collect that, and then meanwhile their spousal benefit, their own benefit based upon their record, was sort of increasing, and then they would flip over to that higher number when they got to age 70. Well, the reality is that doesn't exist anymore. Okay, in 2015, Congress changed it, and that only exists for folks that were born before January of 1954. So if you were born before January 1954, that option sort of still exists. If you were born after 1954, then the option of sort of collecting my spousal benefits and letting my benefits on my work history continue to increase, that is not an option. There's a couple of other parameters that they put in that as well. You have to reach your full retirement age, which would have been 66 for those that are born before 1954, and then your spouse has to collect. There was actually an option that was a file and suspend option that meant that your spouse could apply and then immediately suspend, but because they had filed, then you were able to collect on their record. That also was very much done away back in 2015 as well. So we're going to slide to a break. When we get back from the break, we'll kind of recap this part of the conversation because this is a big rule change. Been around for a few years, but you continue to see it being talked about. There are still some folks that could take advantage of it, but that obviously that number is getting less and less given the age parameter that Social Security set in that ability to draw money off of your spouse's record while letting yours accrue. We'll continue with that when we get back here on Dollars and Cents. This is Joel Garris, News Radio WFLA Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA Orlando. This is Joel Garris of Nelson Financial Planning. And in the last segment, we were talking a little bit about one of those changes that have occurred to Social Security, and that's this notion of being able to collect under your spouse. Generally, you were doing that if your work history gave you a Social Security benefit that was sort of less than roughly half of what your spouse's benefit was, because then you could collect on that number and meanwhile let your benefit continue to grow up or increase, and then you could switch over to that as late as age 70. In 2015, Congress, among many other changes with strategies involving Social Security, eliminated that one for future folks. The only folks that could still take advantage of that are those that were born before January 1 of 1954. They have to reach their full retirement age, and their spouse has to be collecting. So still an option out there, but the window or the availability of that continues to shrink, particularly with that age requirement that you have to be born before 1954. Generally, those folks are getting closer to collecting Social Security or in the middle of collecting Social Security. And so we'll find that becomes less and less of a feature, and certainly not an option if you were born after 1954. So those options really have changed quite a bit. So that strategy is no longer available. So you've really got to be looking more at your work history in order to be able to have that apply. So one of those many things about Social Security that requires a little bit more thought than just running some numbers on an online calculator. We were talking about that on a prior episode. A lot of those online calculators, simple conclusion, wait and live as long as possible. Well, no kidding, but the reality is the money's got to come from somewhere, and the first few years of retirement is when you've got the biggest need for income. Many people think it's the back end, but a lot of studies have been done on it, and in fact, it's early on in retirement. And when you stop and think about it, it sort of makes sense, because when you're first in retirement, you're younger, and when you're younger, you have the ability to do more stuff, and when you do stuff, it usually takes money. So the reality is that is certainly a major factor in planning and how Social Security will, in fact, benefit you the most. So important to kind of look at all of those different pieces of the equation. One other comment on something we were talking about in the first part of the program. Obviously, tomorrow Columbus Day, it is a federal holiday, which means that no mail and the vast majority of banks are going to be closed. But interestingly, it's one of those days where things are different in the market. The stock market, in fact, is open. So a little bit of a one-off there on the stock market, and we wanted to just make sure that we had pointed that out as well. So market is open tomorrow. Banks and mail service are not, due to it being a federal holiday. So kind of one of those oddball things when you stop and think about it. Usually the stock market follows the federal holiday market, but alas, tomorrow it does not. Anyway, the one of the topics that we spent some time on over the course of the past few weeks is this notion of battle of the sexes. We talked a little bit about how sometimes married couples are not on the same page, and obviously we encouraged you to have a conversation and get on the same page, because the do-nothing strategy, or sort of doing things independently and separately from your spouse, really doesn't work, because a lot of things do, in fact, Social Security being one example, depend upon what the other person does or does not do. So it's important to have those conversations, but the reality is that sometimes that battle winds up getting lost and people get divorced. And so we thought we would sort of give you the other side of the coin and some things to be aware of when you're going through a divorce and you've sort of lost the battle of the sexes, if you will. And perhaps one of the biggest things is to just understand the tax nature of your assets. And so when we're having this particular conversation with folks, we'll really want them to sort of divide up what is a pre-tax or taxable type of asset and what is an after-tax type of asset. Because as you might well imagine, right? I mean, based upon the different tax treatment, those assets have very different types of long-term implications with them. An after-tax asset, which is one where the taxes have been paid on it along the way, is going to be much more tax efficient to use that in retirement than a pre-tax asset where it hasn't been taxed at all, nothing's been taxed in it. As you use that money, it is going to be taxable. And so one of the biggest things is to make sure that, well, first of all, understand the difference between pre-tax and post-tax. And what's fascinating is a lot of lawyers don't really have that baseline of financial education. I can speak personally. When I was a practicing lawyer back 20 plus years ago in Washington, D.C., I didn't really know, the difference between pre and post-tax nearly as well as I do now. And so a lot of lawyers don't really appreciate that and understand that. And the reality is that those pre-tax assets, those assets that have never been taxed before, those are pretty heavily regulated by the IRS. And so if you're going to divide that up, those types of accounts, then in that case, you typically need a court order or something called a quadro, which is basically a qualified domestic relations order. And those are the documents that you need in order to carve up, because the IRA custodian or the qualified plan custodian is not going to take your letter and simply divide up an account. There's way too much liability in that. There has to be a legal document that says, hey, you've got to divide this up in order to have that split or that division of that asset actually happen. What's important in that is not just recognizing the pre and post-tax types of assets, but making sure that it's done correctly. We actually had a situation here a couple of years ago in the office where this couple was going through a divorce, and it was very clear in prior conversations that the IRA, a piece of it was going to be split off, and that was pre-tax, and that piece was going to be split off for the benefit of the other spouse. And lo and behold, the actual agreement that was signed by the parties was unclear on that. It talked about it being a distribution of X number of dollars. And the problem with that is that the attorneys proceeded to continue to fight on it, but the problem is that because it was a court order and it talked about it in language of as a distribution, then that person actually had to take the money out, pay taxes on it, and then give that to that soon-to-be ex-spouse. That's clearly one where the old battle of the sexes was definitely lost because they were arguing over that aspect, and the party did not bend on it, even though there was certainly conversation about it being pre-tax in an IRA and slide it over, and there's no tax implications on it. Because the court document had not been written clearly enough, then it created a tremendous amount of tax implications for that individual, for that spouse who had to take the money out, pay the taxes on it in order to give it directly to the other person. So the point is, be very careful, not just on understanding the difference between pre and post-tax assets, but make sure that whatever the agreement is that you're signing, make sure that it's really been carefully read and carefully constructed, because a little bit of change of language could wind up with some pretty negative tax results, which is not at all what you intended. But if the document is written and stamped and signed off on and court ordered at the end of the day, then that's a pretty tough result when you wind up having to pay taxes on top of that. So when we get back, we're going to talk about the other thing that often comes up in divorces, and that is the tax return and how it plays out, and how do you treat the kids, and how do you file, and all that kind of stuff. So we'll continue on with this conversation. Plus, we've got open lines, so feel free to call in and talk about whatever topic is on your mind here on Dollars and Cents. The phone numbers to call in, 407-916-5400. Toll free 1-866-916-5400. Those are the ways in which you can get in touch with us here on the program Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Welcome back to the program, Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Yes, indeed, if you would like to get your topic into the mix of what we're chatting about on the program today, you can follow Bud's directions, which are very simply pick up the phone and give us a call, 407-916-5400. Toll free 1-866-916-5400. Along with, you can also send us an email. Maybe you don't want to get on the air and would rather just send us an email. That's fine as well. The email is Joel, Joel, at NelsonFinancialPlanning.com. Those are the ways in which to get in touch with us here on the program. So in the last part of the program, we were talking about what happens if you lose the battle of the sexes and you wind up going to divorce. And the important piece of that really does start with understanding the tax nature of the assets that you all have. And that's the difference between pre-tax versus post-tax. The pre-tax you've really got to handle very differently, and most importantly, very specifically. I'm reminded of that story that we ran into a couple of years ago where everybody sort of agreed that it was supposed to come out of the IRA and it was going to pre-tax asset and it was just going to be slid over and another IRA was created. But then lo and behold, the court order was written in such a way that it was referred to as an $80,000 distribution, and the folks chose to enforce that as it was written. And so consequently, the spouse who had to pay that money wound up having to take it out and pay taxes on that. And at the end of the day, a little bit thorough and more careful reading of the document that could have been prevented by the party. So the advice there is that before you sign anything, as with anything, before you sign anything, make sure you read it and pay particular attention to split of assets that are of a pre-tax nature. This language of distribution versus rollover, that's where you can run into a major problem, because a distribution, could be twisted as well. That meant that you were going to take the taxes out, and the money going to the other spouse was the after-tax sum of money. So guess what? You've got to pay the taxes. So be very careful of that and make sure that you pay particular attention to that part of any divorce agreement, because you don't want to get saddled with a tax liability that it wasn't the intent to do that. As with any retirement asset, it requires either a court order or a QDRO, qualified domestic relations order, in order to be able to effectively split that and avoid the taxes. So some important things to note there. Along with then, more from a tax perspective as well, the other issue that folks confront during the course of a divorce is, okay, well, what's going to change with the tax return? And the reality is that obviously if it's a divorced couple, then instead of having the ability to file a married filing joint return, both of them will return to sort of their original single tax status. That's pretty straightforward. Where it can get more complicated, obviously, is if there are dependents or children on the return, how that plays out. Make sure that you are at least talking about that or thinking about that or working through that. Oftentimes people with kids, if they've got two kids, well, that's perfect, because then one takes one takes the other. And then that allows both people to be able to file head of household, which is a better tax rate than just simply filing at single rates. The tax ranges and the percentages of income tax payable for those ranges are much broader. And so head of household, for the same amount of income versus single head of household, you would in fact pay less in taxes. So many people like trying to get that, and then that's where the kids come into play. If you have an odd number of kids, well, then typically the answer is the odd years versus even years, things like that. There's a lot of ways in which to address that. But most importantly, that has to be part of the conversation, because post-divorce, you don't want it to be a rush as to who can file first, right? Who can file first is not a very good strategy, because what happens is whoever files first, sort of, that's where the kids will be on that return if they've claimed the kids, because the IRS sort of looks at the first in time more than sort of that overall picture. That's not their job. They just look at, okay, that return came in and this is what it is, and we're processing these Social Security numbers for these dependents, making it impossible for you, the second person, to come in and try and claim those same folks as dependents if they have already been claimed. So you certainly don't want to deal with that kind of a situation. So it's important to kind of talk through the numbers and the conversation on what the future tax return is going to look like. So certainly some important issues there from a divorce perspective, indeed, and one that I think, given the tax nature of the assets, can often get confused a bit. So make sure that you're paying attention to that part if you're going through a divorce, and also make sure that you read the document very carefully. Leave no question as to how an asset is going to be split up and the process for that, particularly on a retirement account, because you need to make sure that retirement account is going to be split such that it doesn't create any tax implications. A distribution from an account suggests that you would wind up having to pay the taxes, and those are the things and the languages in those agreements that you've got to be very, very careful on. So some important things to note on those types of divorce situations. Another thing, important thing to note, is this ongoing conversation that you hear out there about pension plans. And when you look at these numbers, it can be very troubling from a retirement perspective. Let's say you're working for a state or a local government that is offering you a pension benefit, and that's different than sort of your traditional 401ks or what have you that you would see on the private side, but because you're working for a government institution, then typically there would be where you would find the ability to have more of a pension. And what's staggering on that is just how poor the overall funding is on those pensions across the country. Here in Florida, the state of Florida retirement system, the defined benefit plan, actually one of the better ones out there. But if you look at the country as a whole, the numbers are pretty staggering. So we want to share with you those numbers when we get back from this break and talk a little bit about what you need to do to make sure that your pension benefit really is as good as it has been promised and that there aren't any surprises hiding behind the fence, if you will. So we'll be back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning, talking a little bit on the program about some of the pensions that are out there, that pension benefit. You're working hard for your employer, typically a state or a local government, and you think, hey, I'm going to have a pension benefit that's available to me at the end of all of my years of working. Here's where the problem comes into play. The statistics are disturbing, to say the least. If you look across this country, and as a side note, I will comment that the state of Florida's defined benefit pension plan is actually one of the better ones out there in terms of its financial condition. But if you look across this country and you look at all of those state and local pension plans that have promised benefits to their employees, the numbers are kind of staggering when you look at how poorly funded those plans are. The number is that those plans as a whole, in aggregate, are only funded to the tune of 52%. Just barely half funded. Now, what do we mean by that? What does that mean? So the percentage that something is funded, when you look at a pension plan, refers to the amount of the value of the current assets that are held by that plan in comparison to the present value of those future liabilities that the plan has promised to pay out. So let me say that last part again. Okay, so you got all these current retirees and all these future retirees, and based upon the life expectancy of each one of those people and how much is going to be paid out over that life expectancy, that represents a future liability that's spread out over the course of, the next many, many decades. Well, mathematically, you could always take that future stream of income and bring it to what a present value of that would be. And when you do that and compare it to, well, how much assets, in fact, do these plans have, that's where you'll find that 52% number. So that's a little troubling in a lot of respects when you have, and this is the aggregate across the country. So any pension plan offered by state or local government, the study looked at state and local governments, it's only funded to the tune of about 52%, meaning that the assets in place are such that it's only going to cover 52% of what the present value of those future liabilities are expected to be. That's a pretty significant shortfall, and one that if you're working for a state or a local government and expecting a pension, I would urge you, well, first of all, double check the finances of the pension or that you're part of, because that's easy enough to do. Each one of these pension plans has to file an annual report. There's an annual report, there's annual accounting. So I would urge you to look at that and find out what that funding ratio is. The close to 100%. I mean, ideally, you'd like to be at 100%, right? I mean, you want to have enough money in place today to cover all of the future liabilities going forward. Unfortunately, many, vast majority, are not even close to that. That's why the average is that 52%. So, number one, check how good a quality your pension benefit is. And by the way, make that part of your employment decision as well. If you're thinking about, I'm going to, work for a state or a local government because I like the notion of getting that pension and that's something that's important to me, make that part of your decision-making process when you're trying to decide where you want to work, because a pension plan that is not very well funded is going to have a whole lot of changes associated with it. A pension plan that is more fully funded, well, okay, there's probably there's the potential for less changes there. So really dig into that. It's all public information and all readily available with a little bit of research, and make sure that you understand how good your pension is or not based upon that funding ratio. An important exercise to ask. And if you find out that yours isn't very well funded, well, then time to kind of ask around your employer and say, okay, what are you guys going to do to help shore this up? And again, traditionally, it's at state and local government levels that you see these shortfalls, but these shortfalls are a major problem coming down the highway for many people that have worked for state and local governments or are still working for state and local governments and realize that there's the money's not there. So how do you fix that? How do you change that? So really if you're thinking about taking a job for the pension benefit, I would urge you to do that research to find out just how well it is funded. If it's not very well funded, then I would suggest that perhaps you don't make the decision on the benefit of that pension, because that's probably going to change. The other thing that you want to do is you can't just bank on that, right? You can't just rely on, okay, I'm just going to put my years in and I'm going to get a pension benefit and that'll be great. You've got to also be putting aside some money on your own accord so that you have the ability to supplement that pension on your own. If you're sitting there banking on your employer, which is a state or a local government, to be able to generate that pension successfully, I would urge you to rethink that strategy. You've got to also be doing something on your own to help supplement that, because when you look at these numbers, there's no way that these pensions across this country are going to be able to pay the benefits as they are currently promised. Not with a 52% average funding ratio. I mean, that's crazy. So you've got to really make sure you can't rely on, I'm going to get a pension and everything's going to be great in retirement. You've really got to make sure that you're also saving money along the way. Oftentimes with the state or local government, you have the option to do a 457. You always have the option to do an IRA, or if you income qualify, it's a Roth. If you income qualify with the IRA, you even get a tax deduction for it. So there's always other options that you can do. Obviously, if you're working for an employer that has a pension benefit, you might not have to do as much as if you were working for a private employer and it's solely based upon you to fund it. The reality is, though, that a lot of the pensions aren't in particularly good shape. So you really need to also do that additional savings out of your own personal money, because those numbers are going to change. They have to change, particularly when you're only funded by just over half of what you've promised. So something to really consider on that. If you're working and saying, I've got a pension and that's great and I don't have anything to worry about, be careful. You probably do. A little bit of research will tell you exactly how much you've got to worry about, because you should be able to research exactly what the funding percentage is for your expected pension plan. And that's just looking at the underlying pension plan assets and the actuarial reports that are required to be done each and every year. And so that would at least give you an idea of how good or bad a shape your pension benefit might be in. Most importantly, though, you've got to also do that additional savings. There's plenty of ways to do that through 457s, through IRAs, through Roths, and the like. But that number, when you stop and think about that number, and that's the aggregate across this country, state and local government pensions, funding level only at 52%. That is a pretty tough number that's going to have a significant impact on a lot of people that think that they're going to get a pension based upon the rules and the numbers today. Those are all going to change, especially if these plans are only half funded. So just be aware of that. You still got to do your own. You still got to do some saving on your own. You can't bank on that pension in its entirety, unfortunately, in today's world. So make sure you're doing that. The music means, of course, though, that we've got to make sure we get out of here on time because the radio station operates on a very precise schedule. So we're going to wrap it up and get on out of here. And thanks for listening on in to the program. This has been Dollars and Cents with me, your host, Joel Garris of Nelson Financial Planning, here on News Radio WFLA Orlando.